Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today and that you are in great positive mindset, because we're going to talk about potentially a type of business that sounds like a unicorn. A unicorn in a sense where in this field we found companies offering a yield above 4% with high single digit dividend growth and a 6-year total return between 80% up to 221. And we're going to keep like this big winner at the end of the podcast because it's Nelson's favorite. So I'm with Nelson today from Canadian Dividend Investing as well. How are you doing, Nelson, today?
Mike, I'm well, and I'm very excited to talk Canadian life insurance stocks because, like you're talking about, they're kind of unicorns, and that makes them very popular in the dividend growth investing community in Canada. You get a little bit of growth, you get a little bit of yield, and combined, that's a good thing, and that's what a lot of dividend investors are looking for.
Yeah, especially if you want to diversify yourself away from Canadian banks and some pipelines, and then you're looking for something else. Life insurance companies could be quite interesting. First, though, I want to talk a bit about the business model. I have the impression a lot of investors, they see the yield, they see the growth. Those are like, I mean, we're going to talk today about Manulife, Sun Life, Great West Life. They're like, everybody knows them. It's just like commodities, and then you're just like, yeah, they're good companies, but how come they're good companies? What affect them? What is like their pros, their cons in terms of industry, in terms of business model? So first I want to tackle one thing, and then I'm going to let you go. But one thing I want to highlight here is, like the principle of a life insurance is you're giving me money right now, and I promise you that whenever you die, I'm going to pay you back. And in the meantime, I'm going to use that money to make more money. So I have to invest it. And of course, the investment side is really important for the insurance business. And this is probably one of the reasons why they have been doing so well over the past few years, is because the stock market is going up. So they're technically making more money with the investment, the premiums they receive. And then it's all about measuring the risk, of course. The more data you have, the better it is. So you can assess like your life, your risk for life insurance, for healthcare insurance, and then it's always the key is always to make that arbitrage between the money you receive and whenever you have to pay. And one other thing that I want to highlight here is the high dependence on interest rates, because they have to put a lot of that money. I mean, when you think about it, just like, wow, that's amazing. So I'm going to start myself a life insurance company. I'm going to take all those premiums and do like triple leverage on Bitcoin, and then it's going to be perfect. But then there are regulations. You cannot do that. And you have to stack a big chunk of that money into fixed income. So bonds. And of course, when interest rates are low, it's not helping them because they're forced to stake it there, and then they're not generating that much money. So for that's also for a reason maybe they went a little bit on the radar in terms of growth for several years before COVID, when interest rates were super low, pretty much stagnant. So there was not much activity over there. And yes, they did okay, but they were not like shining as they are right now. So what do you think about this business model, Nelson? What do you like? What do you dislike about it?
Sure. So I'm going to back way up here for all the old people listening. I'm going to talk about before the 2008, 2009 financial crisis, because that was a big turning point for the life insurance industry in North America, in Canada too, because you had Manulife that they cut their dividend, and the
Yeah.
other life insurance companies got through unscathed. So what happened then? So the regulations back then allowed the life insurance companies to take a little bit more risk. Not a lot of risk. You talked about how it's mostly in bonds. Even back then it was mostly in bonds. But they took a little bit more risk on that side, and they invested in some bonds that were a little bit, dicey, which at the time looked pretty good,
Commercial
but of course
papers.
ended up ended up not being so good. So emerging from that, they really said, "Whoa, we're a little concerned here, and we want to sort of decrease the amount of risk." So that was kind of the first thing that the life insurance companies did, emerging from the crisis, is they went really low risk, and when interest rates plummeted, that equals very low returns on the interest part of
Hmm.
their investment. So essentially, that handicapped earnings growth for a long time. You just didn't have the earnings growth in that kind of environment. And so that persisted through kind of the late 2010s. And then we got into COVID 2020. And of course, rates basically went to zero at that point. And things weren't looking especially good. So, Mike, you talked about the returns. Well, part of the reason why the returns have been so good is because they came from very depressed valuations. I remember
Yeah.
Manulife traded at about 6 or 7 times earnings back then, which is incredibly cheap. So then what happened? Okay, well, the interest rates went up and these companies immediately got a nice little bump from that. And the other thing that happened was that, you mentioned their investments in technology. Those really started to pay off at that point as well. Life insurance is a bit of a commodity. You give a company money, and in exchange they pay you when you start pushing up daisies. So that also helped on their profitability as well. So basically, what's happened is these two things have sort of combined to increase the earnings potential of these companies. And then the other thing that's happened is that a few of them have turned to more emerging markets, which are
Yep.
higher growth potential, which have also helped there. The other thing I'll mention about the business model itself is that when we think of insurance, we think of Warren Buffett. And you look at Buffett's investments, and the only thing that gets the headlines is, he bought United Healthcare, or he bought Apple, or he bought whatever. But what happens behind the scenes is the vast, vast, vast majority of those insurance earnings get tucked into government bonds because the regulators insist on it. And that's just a prudent thing to do when you constantly have to pay out insurance payouts. So I think that that's sort of what people see when it comes to the insurance business. It's
Hmm.
Buffett and it's sexy and like look at these investments that he made. It's really, really quite boring, but that's okay because that can translate into pretty good returns over time.
Yeah, and you can like put those type of companies on the shelf, forget about them, and still make a lot of money. One last thing that I've noticed in this industry is also the shift towards a bigger part of their earnings coming from either wealth management and retirement services, which kind of makes sense when you think about it, because you have the planning side with the insurance that is part of retirement planning, and they have a very important investment department already to manage their bond and to manage their investment. So might as well offer wealth management services also. So they have increased their business segment in that regard, competing with banks and other asset managers. And definitely, I think even if we look at Canadian banks, a big chunk of the growth is coming from wealth management, and I think it's going to help them. So now we're going to move into the breakdown of four companies. So Manulife, Sun Life, Great West, and your favorite for the end of the show. Uh, One way I like to look at those insurance companies is really to determine what are their business segments so I can make a better decision. Because as you mentioned, I mean, a life insurance contract is really a commodity, meaning that as a consumer, I'm going to meet with those three big guys. They're going to offer me a contract. And in the end, the only thing I want is to pay the lowest premium possible to get the highest claim possible. So if you're telling me I can get insured for $1 million and it costs me like $50 a month, that's a done deal. If the other one's at 55, well, too bad. I'm going to go for the one at 50. So it's limited in terms of diversification. So then you need to have other types of business segment. So when we look at that, we have Manulife, that is the only one that cut their dividend during the financial crisis. Great West and Sun Life, they stay put for a few years and then they started back to grow. And that earned them the big penalty box. Like for like what, like 20 years, it was the undervalued underdog. Like, oh yeah, buy Manulife, it's going to jump out. And it finally happened, which I find interesting. And it's probably because they have diversified away from the Canadian and the US market, which is about 20% each of their earnings. So 21% for Canada, 22% for the US. But then we have 23 in wealth management, and about a third of their earnings are coming from Asia. And this is what you mentioned, like big exposure to emerging markets, lots of money to be made over there, and they have over 1 trillion in assets under management. So definitely very solid into the wealth management side. What do you think about Manulife? Because personally, it's my least favorite, even though it has skyrocketed as of late.
Yeah, so Manulife is really a growth on Asia play from my perspective. Of course, it's got the Canadian US divisions, like you mentioned, but ultimately, I think it's Asia that drives this one. The Asian expansion is a good one, I think. You've got these developing markets, the Philippines, India. Manulife's big into the like Hong Kong, East Asia market, which is a little bit scary because Hong Kong and China, and there's that sort of risk there. But ultimately, Asia really comes down to there's a lot of people there are getting richer, and these folks want to protect their
Hmm.
lives, protect their earnings, protect their assets, etc. And that opens up a door for companies like Manulife who have expanded pretty significantly in the region. And that has resulted in some really nice earnings growth. Like you look at Manulife's earnings growth sort of in the last, say, 5 to 10 years, and Asia's driving a lot of it.
Yeah.
Canadian, yeah, it's improving, the US is improving, but Asia's really been the big driver. So the risk there, of course, is that when Asia inevitably sort of hits a speed bump or whatever, that the those earnings will struggle, and you've got the sort of that risk there. It's a little bit more volatile than in Canada and the US because we're more mature economies. So that's kind of the issue with Manulife. And two, Mike, you mentioned about the dividend cut. I remember talking about Manulife to people in 2021, 2022. So this is like almost 15 years after the dividend cut, and people still remembered. It was
Yeah.
like, I'm not going to invest in Manulife because it cut the dividend 15 years ago. And I think that that's maybe a little bit too long of a memory, but it just goes to show how many Canadians were invested in it back then and how many got burned, and how that even to this day, that still affects the stock.
Yeah, I haven't been burned back then, but that was also one of my main argument why I didn't like Manulife, just because after the financial crisis, they have not been really tested. So the only back testing that you have is okay, if like shit's at the fan, well, you know that Sun Life and Great West have like had a better management back then, better solution, like better balance sheet, and being able to maintain their dividend. As you mentioned, though, that is often a price that comes when you are geared towards a little bit more growth. And this is what Man Life is, a little bit more volatile, great expansion over there. So overall, not necessarily a bad thing. Pretty much like the Canadian Bank discussion that we had 2 weeks ago, where if you pick one, you're probably going to have a solid dividend payer. And then finally, Man Life, I think, convinced investors that that happened in the past. Now they have a better business model and they're ready to move on. Another one that I really like, though, but I don't have any position in it. It's Sun Life. I like it because they have their biggest chunk of earnings is coming from assets and wealth management. So about 40% of their business is coming from there, 30% from traditional life insurance business, and then an interesting yet right now a I don't know a rock in their shoes is the other 30% is coming from group and health insurance. They ran into um, several problems, like less making a lot less money than they thought with their recent acquisition in dental healthcare in the US. So sometimes when you grow by acquisition and then you're trying to expand your business model, you get hurt. So for Sun Life, it's really a good play on wealth management. But for the growth part regarding the group and healthcare insurance, maybe it's going to lag a little bit. They got bad press around the past few quarters with over 1 trillion as well, and with under assets under management. So overall, interesting play, but could get hurt over the next 2 years for that reason.
Yeah, the interesting part about US health insurance, and of course, Sun Life is a little bit more on the periphery when we talk about US health insurance. Everyone thinks about the, like you go into the hospital, you have a baby, and you come up with a $30,000 bill, and everyone is, like there's definite issues with the U.S. health insurance part of it, but Sun Life, to their credit, they're a little bit more on the periphery when it comes to that. They're looking at things like dental care and things like that. So it's like their benefits business in Canada, where you're just sort of paying for things that aren't necessarily hospital things. They're health related things, but they're not hospital things. So long term, I like that. But Mike, you're absolutely right. In the short term, what happened was they came out with these earnings, and in the earnings, they basically said, "Look, there's some uncertainty involving the dental part of the business. There were things that Medicare was paying for, and now Medicare is not paying for, and that caused a one-time hit to earnings." And of course, investors look at that and they say, "Hey, that sounds like more than a one-time hit to earnings. That sounds like a big deal," and they overreact because investors always overreact to stuff
It's
like that.
the name of the game, right?
Exactly. So you've got that going for you. I think it's short term, but it's definitely something you have to look at. And the other thing I'll mention about wealth management, I really like Sun Life's wealth management business, and I like all of the insurance companies getting into wealth management because at the end of the day, if you have a army of wealth managers, and Mike, you know this, former banker,
Oh,
whose products are they going to sell first? They're going to, a Sun Life advisor is going to sell Sun Life's products first, as they should. So that saves the company a lot of money in paying commissions and having a sales force and so on. So it's kind of like this vertically integrated kind of model. And I think that's a good model. And, you'll see, I think, kind of more growth in that wealth management from Sun Life going forward because it's a perfect way to sell their products without having to do all that extra work of trying to convince a competing advisor to sell those products.
yeah, and from my personal experience, I was quite impressed was while I was a private banker with Sun Life like sales pitch and like documents and retirement planning services that they were offering. I used to do that for National Bank, but then I was like, well, those are like they are serious competitors because sometimes like in house you're just looking at other like banks and life insurance companies, and then you're just like, oh, damn, they suck, or those are like very good guys. And I was like, yeah, Sun Life, they're solid. They have like those like nice shiny binders and so on. So yeah, definitely, they have realized that they can wrap up the client and sell a lot of products, including the life insurance, but also the investment part. Moving on to Great West, this one is more of a classic life insurance company play in a sense where they have like about 30% in US, 30% in Canada, 20% in Europe. So if you want to have exposure to Europe, this is where you're going to get it, and about 20% in wealth management. So one thing that I really like about Great West, though, is that they're backed by Power Corporation. And Power Corporation, when you look at their business model and their financial statement, Great West is a huge part of them. Like it's the huge reason why they're growing. They've been doing very well over the past few years, and probably using a more of a classic approach. They did a very good expansion in the US at the same time. This is one that I have in my Smith Manaver account, but it's a very, very small position. I have like about $1,000 in it. So it's not going to move the needle, but I might consider adding a little bit more over time. I'm still not convinced. I like companies that have a little bit more growth exposure. So for those, they're nice. They come with some growth at this point, but over the past 10-15 years was not always the case. So we'll see how it goes in the future. Do you have any opinion on Great West before we move to your favorite one?
Well, I definitely want to get to that favorite one, so I'll be really quick here. The Great West Life has Empower in the United States, which is one of their largest retirement providers in terms of the retirement savings and things like that. I think there's a lot of growth potential for that business in the future as we get more and more to sort of self-directed retirement accounts for employees. So I think that there's some good growth potential there, but that's made up for by a little bit more of call them boring Canadian and European assets, where it's like, yeah, there's some growth potential in Canada and in Europe. But I think the US is the play for Great West Life. And that business, the Empower business, just gets more and more efficient as more people join up and as the technology gets better to, you can increase your return on equity and things like that from that. But overall, I'm with you a little bit, Mike. It's more the boring one, and the dividend yield kind of reflects that.
Yeah, I mean it's just like printing money, and it's definitely the type of business you put on the shelf, you forget about it, and you're still gonna be good. But now you have your favorite that is a lot more aligned with my strategy, actually. A lower yield, more growth perspective, smaller life insurance company, IA Financial. I'm quite curious about it, so I'm going to let you talk about it. Maybe going to ask a few questions after it.
Sure. So IA Financial is traditionally a life insurance company that has expanded into various other kind of auxiliary wealth businesses. So they have a dealer services business, which is basically those add-ons that you get from the dealership. They are the ones who sort of underwrite that. So a dealership will, give you like an insurance policy, and it's IA Financial that's sort of underwriting that. So there's growth there. There's growth in the wealth management side. So
Hmm.
they're acquiring kind of these Canadian boutique wealth managers. They have a property and casualty division, so it's not just life insurance. They've got that part of it as well. And basically, they've been a growth by acquisition name for a very long time. I think they've made something like 15 acquisitions in the last 10 years. They have a culture where they can buy these things, integrate them into the company, and have the whole thing sort of roll forward. So, what that's resulted in is better growth than its competitors, which has translated into better dividend growth than the other guys have delivered. So, dividend growth's been about 10% a year for the last decade. And more recently, they've established a policy where they increase the dividend every 3 quarters rather than every 4 quarters,
Well,
which
that's nice.
translates into an extra dividend increase every kind of 3 years. So basically, you have a company that's growing faster than peers, and yet, at this point, stock's about 150 bucks, should earn about $14 this year. So it trades just a little bit over 10 times earnings, which is kind of where its peers trade. So in short, you have better growth potential with about the same valuation and ultimately better dividend growth potential and a far lower payout ratio. Payout ratio right now is in the 30% range versus kind of 50% for the rest of the peers. So you put it all together, that's it. It's better growth at about the same valuation.
Yeah, and I'm looking at the dividend triangle on Dividend Stocks Rock right now, where I see the past 10 years of like revenue, earnings per share, and dividend growth. And I see the dividend that was going up nicely before COVID, but after COVID, they really hit another level. Now they're in the past 5 years, I see it as like 13.75 dividend growth rate. So pretty solid here. And as you mentioned, like low payout ratio, strong dividend growth. The business is not about to slow down. I didn't know that they were a little bit more diversified than the others in terms of like business segment. Because it's one thing to be like if like Great West, you're selling insurance in Canada, in the US, or in Europe, you're still selling life insurance. But having those other casualty or the add-ons to the dealership, and God knows how profitable they must be, those one, because they like when you get a new car, they're trying to push them very hard, so it must be very profitable. If not, they would not do it. So very interesting one. The yield is a little bit lower for people that are looking for income, but still reasonable at like 2.6,
Mhm.
considering that the stock used to trade around 90 bucks towards the end of like 2024. I mean, mid 2024, we're like between 85, 90 bucks, and then it jumped to about 130 at the beginning of this year, and now we're at 150. And still, what I really like about what you mentioned is still trading at a very decent valuation in terms of PE ratio. So we're not talking about a stock that is getting just popular and on the hype with a P expansion, but what really drives the stock price is earnings expansion. Literally, like they're making more money So that just makes sense that you pay a higher price. So you're not necessarily paying more for it. It's pretty much aligned with the overall valuation. So definitely one that I'm going to put on my list now. Thanks, Nelson, for this one. Find it very interesting.
Yeah, this is right up your alley, Mike. It's like the growth is good, management is good, and I'll add that these guys intentionally put money aside every year. Basically, they say we're going to take 30%, 40% of our earnings, and we're putting them aside for acquisitions. And if we don't find any acquisitions, then we're going to repurchase shares. And that's the other thing I want to mention is that in 2024, these guys repurchased something like 6% of shares outstanding. They did a little bit more this year, and then they made an acquisition in the summer. They bought RF, the old Richardson financial advisory business. So this came with a bunch of financial advisors just adding on to their wealth management business. But that's the thing with these guys. Like they will, if they can't find anything to buy, they'll buy back stock. And I'm a fan of that because that always increases earnings and makes
Mm-hmm.
dividends easier to pay. If there's fewer shares outstanding, that helps those factors as well. So that's another reason why I like this one.
Yeah, so sometimes going for a smaller player, I mean, we're talking about companies like Great West Sun Life for like 50 billion market cap. This one is like 14. So sometimes going for the smallest players is also an interesting play. I mean, you know my love for National Bank. IA Financial seems to have a similar playbook where they're just like going under the radar, but growing a lot faster than the big guys. So very interesting one. So, all right, Moose, we're already at 26 minutes, so we're expanding right now. We want to like wrap it up. So, again, thank you, Nelson from Canadian Dividend Investing newsletter. Do not forget to subscribe to his newsletter on top of liking the Moose on the Loose. If you have any comments, any suggestions about the Moose, you can go on YouTube and let us comment over there. I always love to get inspiration from you guys. So, all right, Moose, we're going to talk again tomorrow. And until then, don't forget to stay invested.